Welcome to today's deep dive into the document Options Analytics for Premium Sellers. Our mission today is figuring out how you can smartly generate income from options, without getting burned by all those hidden risks.
Right, because there are a lot of them out there.
Oh, absolutely. So, okay, let's unpack this. Imagine you are staring at your options chain. You see a contract expiring tomorrow,
Mm.
and someone is willing to pay you like $1,000 just to sell a put right before an earnings call.
Sounds like free money, right?
Exactly. But in the world of options selling, that giant premium usually means the market knows something terrifying that you don't.
Yeah, what's fascinating here is that a massive premium isn't a gift. It is basically hazard pay.
Hazard pay, I like that.
Right, because evaluating an option based purely on the raw dollar amount of the premium, well, it's the easiest way to blow up an account. When the market prices an option that richly, it's pricing in massive impending risk.
It's kind of like selling hurricane insurance the day a Category 5 storm hits the coast.
Yes, exactly.
Yes, the premiums are sky high, but that's because the house is actively shaking. So what does this all mean for actually finding good trades? If we can't trust the raw dollar signs, what do we do?
Well, you have to look past the absolute premium. You need to isolate the implied volatility rank, or 5E rank.
Wait, how is that different from just normal implied volatility?
So raw implied volatility just tells you the market expects a big move. But 5E rank tells you where that current volatility sits relative to its own 52-week historical range.
Right, because a 50% IV might be, historically low for a highly volatile tech stock.
Yep, completely normal for them.
But it would be record-breaking for some sleepy utility company.
Precisely. If a stock's IV rank is 80 or 90, it means the options are genuinely expensive relative to how that specific stock normally trades.
Okay.
That's your signal that a premium is actually historically rich.
Wait, so let me challenge that premise for a second.
Sure, go ahead.
If IV rank tells us a premium is historically rich, and we know volatility tends to revert to the mean, why shouldn't I just blindly scan for options with an IV rank over 80 and just sell them all? Doesn't the math say I'll win?
Well, the math says you'll win frequently, but it does not protect you from the magnitude of a sudden loss.
Right. The catch.
Yeah, this is where premium sellers get crushed by the Greeks. Everyone knows theta is the premium seller's friend, the time decay, but the trap is ignoring the theta to vega ratio.
Because vega is your position's sensitivity to volatility changes.
Precisely. When implied volatility expands, the market is suddenly pricing in a much wider range of potential stock movement.
Even if the stock price hasn't actually moved yet.
Exactly. The inflated probability that it might swing wildly means the option you sold is now significantly more expensive to buy back.
Oh, wow.
Yeah, you might be collecting, say, $10 of theta decay a day, but if your vega is sitting at $50, even a minor volatility spike wipes out a week of time decay instantly.
And this is where that probability of profit metric can be dangerously deceptive, right?
Incredibly deceptive.
Because if you're looking at your brokerage platform right now, you might see a 90% probability of profit and feel invincible.
Right. But a high probability trade isn't a magic bullet if you're carrying undefined tail risk.
Like with naked calls, for instance.
Yes. If that stock shoots to the moon on unexpected news, that one tiny 10% low probability event can wipe out your entire portfolio.
Regardless of the 90% win rate you had on all those previous trades.
Exactly. Which is why having a mechanical discipline sequence is non-negotiable. You can't just isolate one metric.
Makes sense.
But if we connect this to the bigger picture, the most critical filter in this analytical sequence isn't even a Greek. It is liquidity.
That's such a great point. Because you can have the perfect setup. Like an 85 IV rank, a great theta to vega ratio, high probability of profit.
Yeah, that works.
But if the volume is practically zero and the bid-ask spread is a mile wide, you are trapped in a burning building with no exit doors.
If a trade turns against you, and you need to buy it back to stop the bleeding, well, wide bid-ask spreads will force you to pay a massive penalty just to close the position.
Just to get out.
Yeah, slippage will completely destroy whatever edge your analytics originally gave you.
So the actual workflow needs to be rigid. Let's summarize the steps. You scan for high IV rank to find historically rich premiums.
Right.
Then immediately check liquidity and bid-ask spreads. After that, review the calendar for upcoming binary events like earnings.
And watch out for those Category 5 hurricanes.
Exactly. And finally, you weigh your theta against your vega and evaluate the actual tail risk.
Yep.
So it's really about collecting the right premium at the right time, not just the biggest one.
Absolutely. But There is one final layer to this risk management, especially regarding that tail risk we talked about.
Okay, what's that?
If you followed this entire analytical workflow perfectly, you might have 10 high probability trades on the books.
Yeah.
But if they are highly correlated, say, they all rely on the broader market staying calm, are you actually managing your risk or just multiplying a single point of failure?
Oof. Yeah.
Right? I mean, think about it. You might have carefully checked the brakes on every single car in your garage, but what happens if you are forced to drive them all on the exact same icy road?